Good morning, everyone, and welcome to the ProNexus Lease Accounting webinar. For sound check purposes, please click the raise hand button at the bottom of your screen if you can hear me okay. Excellent. Looks like audio is working just fine. By way of introduction, my name is Rafael Vidal. I'm one of the founding partners of ProNexus and lead partner for Leases. With me, I have Dan Hawthorne and Mike Knapp, both a part of our lease accounting advisory and implementation team. We have our email addresses on this slide, so feel free to jot those down now in the event you'd like to reach out to us individually after the presentation. Before we begin, we do have a few housekeeping items to address. You will be muted for the duration of this presentation, so if you have any questions, please use the Q&A feature at the bottom of the screen. We will answer some questions throughout the session and at the end, and there's a recorded version of the webinar that will be sent to all participants as well. Lastly, we will have a few polling questions throughout the presentation. We ask that you take a few seconds to answer those questions as they come through. For those of you on the call who are not familiar with ProNexus, ProNexus was founded by two Big Four CPAs from PwC and Deloitte & Touche. The entire leadership team are either CPAs and former controllers and CFOs. We operate the firm very much like a CPA firm. However, we only perform non-attest services. We have 5 core services, which include consulting, project work, outsourced accounting services, interim, and loan staff services. If you'd like to learn more, feel free to visit our website. On the homepage in the upper right-hand corner, there's a link to our case studies, which really gives you a good idea of how we help clients. In terms of experience with leases for the last 2+ years, ProNexus has been helping companies implement the new lease accounting standard. We've developed a significant number of IP and tools to streamline the process. In addition, we've invested into lease accounting software to help clients accelerate the implementation. And we've worked with clients that have as few as 10 to thousands of leases as well. As you can see, we have an action-packed agenda for you this morning. Agenda items 1 through 11 will provide you an overview of the new lease accounting standard. Items 12 through 18 will provide you a roadmap on getting started, including keys to success and pitfalls to avoid. Item 19 will provide you some software solutions to consider. Finally, we will wrap up with some recommendations, how we can help, and some Q&A. Before we begin, we're going to give you 15 seconds to answer our first polling question. Excellent. Thank you for responding. Okay, so ASC 842 is a challenge. As illustrated in this graph, nearly half of executives are concerned about the implementation. 842 is also pervasive. It affects any client that follows GAAP and has basic operating leases. With the amount of data required to be abstracted and some of the complicated calculations, the implementation is complex, especially if you're considering utilizing spreadsheets. Also, with other competing requirements, for example, RevRec, it's been a lower priority for some clients. We're finding that there's more work involved implementing the new lease standard than there was with RevRec. So what is the new lease standard? The new lease standard is intended to account for all lease obligations on the financial statements. The end goal is to provide more transparency around leasing contracts. Operating leases will now be treated as assets and liabilities. So when are you required to use the new standard? Well, as many of you may have heard, the FASB delayed the date to comply for another year because of the global pandemic. So for non-public organizations, this will move the requirement to the fiscal year starting after December 15, 21. And for public nonprofit entities, this moves the requirement to fiscal year starting after December 15th, 2020. So with this delay, our biggest fear is and was that clients would just put this off for another year and kind of be in the same position as they were before. Most 1231 private clients will be required to comply in 2022. However, day one, which is processing the lease activity the new way, begins on 1/1/22. So we really only have less than 11 months to get ready for day one. So although 842 may not be in scope today, we do recommend you start thinking about and planning for 842 implementation, especially if you have third parties like your bank, for example, that are relying on GAAP financials. There's a lot more work involved than people think, so it's good to get a head start on this. In addition, we don't recommend starting in 2022 because you would have to retroactively go back to account for lease activity differently. Best practices is to have all the chart of accounts properly structured and the lease administration processes in play before 1/1/22. Having said that, some of our private and not-for-profit clients have already started their implementation projects. There is no penalty to adopt early, and we recommend those companies to continue with implementation efforts at a much less rigorous pace. For those of you that have not adopted, at a minimum, we would recommend to get started now with one of two options or a combination thereof. The first is completing the planning, scoping, and assessment phases of the implementation. This is not a lot of work, and we will it'll really provide the company visibility to what's ahead while identifying some of the high-risk areas and planning accordingly to meet the compliance deadlines. Option two is to purchase some lease accounting software, begin abstracting the data elements from the existing leases and contracts and uploading that data into the software. So this will allow companies to maintain the lease data in a central repository, estimate what your day one ready-use calculations may look like, and allow for a quick and seamless implementation when the time comes. This would be no different than having fixed asset software for your fixed assets. The lease accounting software is cost-effective and can be purchased through our firm. For example, if you have 10 leases, it would cost you no more than $1,500 per year for a subscription license. For that price, this solution is highly recommended over the alternative of using cumbersome Excel spreadsheets. So what qualifies as a lease? To qualify as a lease under the new standard, it must be a physical asset. You must have the right to control or use the asset, and the asset must be explicitly or implicitly identified. Understanding the new rules. At a high level, the end goal is to provide more transparency around leasing contracts. Operating leases will now be treated as assets and liabilities, and some procurement contracts may contain embedded leases, for example, raw material procurement contracts or warehousing agreements. I'll turn it over to Dan to provide some further insight on embedded leases. Dan?
Thanks, Raphael. ASC 842 actually requires you to examine all contracts to determine whether each contract is or contains a lease. A contract has an embedded lease if there is an identifiable asset and the lessee has control of that asset and receives substantially all of the economic benefit. For example, one of our clients had a warehousing contract that did not qualify as an operating lease under 840, but did qualify as an operating lease under 842. The warehouse was identified as the asset. The lessor did not have the right to service other customers without permission from the lessee, therefore had control. And the lessee had 90% or more of the warehouse's capacity, therefore received substantially all of the economic benefit. This service contract now qualifies as an operating lease under 842, and you would have to record an asset and a liability. Excuse me. We also have a medical client with agreements to purchase minimum amounts of supplies and in return receives the related equipment needed to use those supplies at no cost. For example, they have a procurement agreement to purchase leg compression sleeves and accessories for hospital inpatients to prevent blood clots. A minimum commitment to purchase supplies includes the related compression machines at no cost for the life of the contract, and they are returned to the provider at the end of the term. On the surface, this may look like a procurement contract for the purchase of medical supplies, but now this client needs to look closer at this contract to determine whether the compression machine would meet the definition of an ROU asset and be considered an embedded lease, which it was.
Thanks, Dan. So as you can imagine, there's now additional visibility provided to leases, which will increase the level of scrutiny from your auditors. So expect to spend some more time testing the completeness and accuracy of your lease data. So what is the impact of the new lease standard? With leases transitioning to the balance sheet, CFOs need to consider the impact to your financial performance metrics, such as working capital. Executive compensation and performance plans could be impacted, and compliance with debt covenants and your borrowing ability. Clients are concerned about potentially violating bank loan covenants under 842, so we highly recommend getting a handle on the potential impact and starting conversations with your bank as early as possible. Additionally, companies will need to address how much effort will be required to comply and what the administrative burden may be for accounting and other departments such as IT. As a reminder, if you have any questions, please use the Q&A feature at the bottom of the screen. Dan and Mike, there looks like there might be one in there now, just an FYI. I'm going to turn it over to Mike to discuss the differences between 842 and 840. Mike?
Thanks, Raphael. As you probably know, ASC 840 had identified two types of leases, operating and capital leases. Capital leases have been treated as long-term assets and are capitalized to the balance sheet. Operating leases, on the other hand, are recognized as period expenses. These haven't been capitalized to the balance sheet, but balance sheet adjustments may be needed to recognize the expense on a straight line basis. On this slide, we will look at the new aspects of ASC 842 and how they compare to the old standard. As we've already discussed, the new standard provides a little more clarity on the scope and definition of what qualifies as a lease. But basically, a lease is an identified asset that you control for a specified period of time. US GAAP, IFRS, and GASB have all come out with new standards. While each group's original intent was to better align the three, they haven't been aligned in all areas, and they may require separate accounting. But today's presentation will be focused on US GAAP. If you do follow IFRS or GASB, or you just want additional information, we'd be happy to schedule some time to discuss this with you. But you may want to keep in mind that we will be starting some GASB 87 webinars and GASB specific software demos in 2021, which we're in now. Under the new standard, accounting for the lessor is relatively unchanged. There are some new classifications, criteria, and modifications that leverage certain guidance in the new RevRec standards, but the new lessor accounting remains similar to the existing standard. And because of this, today's presentation will be focused around the lessee. If you are a lessor, we'd be happy to schedule some time to discuss those requirements with you. Under the new standard, treatment of capital leases, which are now called finance leases, also remains relatively unchanged. The big change in the new standard is with operating leases, which must be now capitalized on the balance sheet. We'll talk about the steps in more detail, but here's a quick overview, which covers items 5 and 6 in the current slide. A right of use liability is first recorded and is calculated as the present value of all future lease payments. Basically, you're creating a loan amortization schedule. A right-of-use asset is then calculated to be equal to the initial right-of-use liability plus or minus any adjustments, such as upfront payments or existing ASC 840 liabilities. Then in subsequent months, adjustments will be made to these initial balances. The liability will be adjusted like a normal loan amortization based on cash payments less a calculated interest expense. A straight line expense will be determined based on the total lease payments divided by the total number of periods. And the asset amortization will equal this straight line expense less the current period interest expense. In the coming slides, we'll also discuss some required changes to the balance sheet, income statement, and cash flow presentation, as well as significant changes with the required disclosures. And the new standard introduces a few policy elections and practical expedients that you can choose to elect. In some cases, these may help ease the burden of implementation. In other cases, they become more of a best practices type of election. The following slides will cover items 5 to 9 in more detail, and Dan will start by covering the initial recognition and measurement.
Thanks, Mike. For the balance sheet, the recognition and measurement of new operating and finance leases, once you have implemented the standard, which we refer to as after day one, for both the ROU asset and liability, will be the present value of the lease payments using the discount rate. The asset will then be adjusted for any prepayments made or incentives received. For existing operating leases, as of the implementation date, which we refer to as day one, the ROU asset and liability will be the present value of the remaining lease payments. The asset will then be adjusted by any other 840 balances related to that lease. For example, prepaid or deferred rents that exist on the balance sheet. For existing capital leases, which Mike mentioned are now referred to as finance leases, the ROU liability will increase based on the interest method using the discount rate and will be reduced by any payments made. The ROU asset will generally amortize over a straight line basis. Expenses on the income statement generally will be front loaded for finance leases and straight line for operating leases. All right, now we'll talk about the balance sheet presentation. The balance sheet presentation for the ROU asset can be presented either separately or together with other assets. If presented together with other assets, you will be required to disclose the line items that include the ROU assets and their amounts. Finance lease ROU assets must be presented separately from the operating lease ROU assets. These assets are subject to the same classification as other non-financial assets as your reporting requirements require. The ROU liability can be presented either separately or together with other liabilities. If presented together with the other liabilities, you will be required to disclose the line items that include the lease liabilities and their amounts. Financing lease liabilities must be presented separately from operating lease liabilities. Both these liabilities, again, are subject to the current and non-current classification similar to other financial liabilities. For leases dominated in foreign currencies where remeasurement to the lessee's functional currency is required, you'll need to keep in mind that the ROU asset is a non-monetary asset and will be measured at historical cost and is not affected by subsequent changes in the exchange rates. On the other hand, the lease liability is a monetary asset and will be remeasured at the period end exchange rate. Changes in the lease liabilities due to changes in the exchange rates will be recognized in profit and loss. Now, Mike will address the income statement presentation requirements.
Thanks, Dan. As you may have noticed, a lot of the new accounting treatment and disclosure requirements have been differentiated between operating and finance leases. Under the new standard, expenses related to finance leases will have two components, interest and amortization. And this is consistent with the current capital lease treatment. The income statement presentation will need to be consistent with how the company records similar expenses. And a company's interest expense will be determined based on the related loan amortization schedule, and this should be included with other interest expense. The right-of-use asset will be amortized on a straight-line basis, and this expense is included with a company's other depreciation and amortization. Because the amortization expense is fixed and interest expense decreases over time, this treatment for finance leases results in more expense in earlier years and less in later years. As Dan mentioned, it's front-loaded. For operating leases, the lease expense will be presented as a single operating expense in income from continuing operations. And as we mentioned previously, the lease expense will be recognized on a straight-line basis over the term of the lease. The lease cost will then be recorded as a single line item without any differentiation between the interest and amortization components. Moving on to the statement of cash flows, payments made for finance leases will again be broken out into two components. The principal portion of the lease liability will be recorded with financing activities, while the interest portion will be recorded with operating activities. For operating leases, it's another one-line disclosure. The entire lease payment will be recorded with operating activities. Now, any short-term or variable lease payments will also be disclosed as a single line item use of operating funds. The new standard also requires non-cash disclosures to reflect any right-of-use assets obtained in exchange for the new lease liabilities. And in addition to the non-cash disclosures, there are certain required qualitative and quantitative disclosures. And Dan will now discuss the qualitative requirements.
Thanks, Mike. The qualitative disclosure objective is to enable the financial statement user to assess the amount, timing, and uncertainty of cash flows arising from the recording of leases. This disclosure should include information about the nature of the lease portfolio, basis, terms, and conditions on which variable lease payments are determined, extensions, terminations, and purchase options, options that are and aren't recognized as part of the ROU assets and liabilities, restrictions or covenants imposed by leases, significant assumptions and judgments made, information about leases that have not yet commenced, but that create a significant right and obligation for the lessee, lease transactions between related parties, and any other significant information that you feel important that the financial statement user should have.
I think Mike's going to discuss the quantitative disclosures next, right, Mike?
Yep. The table on the screen provides an example of what your new footnote disclosure may look like. For each period presented in the financial statements, a lessee must disclose the amounts relating to the lessee's total lease cost and the cash flows arising from lease transactions, separated by finance and operating leases. This slide is presented almost exactly as it's defined in ASC 842, presenting the 10 required elements from the standard. And again, as we mentioned previously, your finance lease costs will consist of those two components, amortization and interest, while your operating lease costs will be presented as a single amount. A quick review of this table shows that we also have to disclose any short-term or variable lease costs, any sublease income, gains or losses on any sale and leaseback transactions, operating and financing cash flows, the right of use assets obtained in exchange for new lease liabilities, weighted average lease terms, and weighted average discount rates. And as a final recommendation, you will still want to disclose your future obligations for your commitments and contingencies. I'll now turn it back to Raphael so he can summarize what we've covered.
Thanks, Mike. So in this section of slides, we covered quite a bit of material, including the comparisons between 840 and 842. We talked about the initial calculations and schedules. We looked at the balance sheet, income statement, and cash flow presentations, as well as the disclosures. So as a reminder for everybody on the call, if you have any questions, please use the Q&A feature at the bottom of the screen. We'll try to answer those as we go through. We're going to give you a few seconds to ask some of those questions while I turn it over to Dan to discuss the policy elections.
Dan, I think you're on mute.
And I think he's just giving everyone some time to ask a few questions in the Q&A feature.
Yep.
Thank you, though.
Okay, I don't see any questions coming through right now, so we'll continue. The new standard allows for policy elections to be made for compliance as of day one. Keep in mind that once these have been made, they're not to be changed. They're not easily changeable. The policies can differ by asset class. For example, you can have different policies for real estate versus equipment. We're not going to discuss all of them in detail, but provide a few examples. So the election can be made not to include any leases with terms of 12 months or less in your ROU calculations. You can choose not to show 842 comparative periods, only the current periods. These are a couple examples of easy choices. Mike will now go through one of the more complicated ones.
Thanks, Dan. When I first heard about the new lease standard, I thought it would be pretty straightforward. After all, we're just adding an asset and liability to the balance sheet, right? However, after reading through the standard, plus some additional literature, I discovered that it was more complex than I would have expected, with some fairly technical guidance. For example, the concept of lease and non-lease components contains some of this guidance. Now, after determining that a contract contains a lease, an entity must identify any separate lease components within the contract, and the entity would consider the right to use an underlying asset to be a separate lease component, that is, separate from any other lease components of the contract. Now, this happens if both of the following criteria are met. One, the lessee can benefit from the right of use either on its own or together with other resources that are readily available to the lessee. And two, the right of use is neither highly dependent on nor highly interrelated with the other rights to use underlying assets in the contract. And then the consideration in the contract must be allocated to each separate lease component and non-lease component. Now, components of a contract include only those items or activities that transfer a good or service to the lessee. But administrative tasks and reimbursement or payment of the lessor's costs are not components of a contract and would not receive an allocation of the consideration in that contract. Now, to me, this part of the standard jumped around a bit and was a little bit confusing, and I had to reread it several times. But basically, it says that a contract may contain certain items that are considered lease components, certain items that are considered non-lease components, and certain items that are neither. And there's a proper way to handle each of these. I'll walk you through a quick example that may help to explain this. Now, with an office lease, you might be required to pay for the office space, common area maintenance, real estate taxes, and insurance. In this type of lease, the office space and the common area maintenance are considered components because they are either an asset or a service. The office space is a leased component since it is the identified asset. And the common area maintenance is a non-lease component because this is a service, and use of the office space is not impacted by whether or not this service is performed. For example, if the landlord doesn't cut the grass or clean the common areas, the tenant can still use the office space. However, taxes and insurance are not components of a lease, since these are neither a good nor a service. They are the lessor's cost obligations. Therefore, the cost for these taxes and insurance must now be allocated between the lease and the non-lease components. It is the costs related to the lease component that are then used to calculate the right of use asset, and the common area maintenance costs are ignored for this calculation. Now, this exercise is a lot of effort for a lessee to go through for each lease, especially if they have hundreds of such leases. But because of this, the standard allows a practical expedient to ease this burden. Under this expedient, you can elect to combine any lease and non-lease components and forego these calculations. This will ultimately increase your right of use asset and liability calculations, but it can greatly simplify the process. I'll now turn it back to Raphael to discuss our next steps.
Thanks, Mike. Wow, that was a lot of material there. Good news is there are some practical expedients, and we still have the majority of our attendees that started with us on the call. Okay, the next topic is going to be what to expect from your audit firm. So many clients have asked us what to expect from their audit firms. The answer really varies, but the reality is most of the CPA firms, excluding maybe the top 10 or so CPA firms, have been or are still trying to figure it out themselves. And looking back, 50% of the public company audits needed additional effort because of 842, especially those that use spreadsheet solutions like Excel. On this slide is a typical lease audit roadmap that's being used by the Big Four CPA firms. ProNexus has adopted a three-phased approach to accommodate the lease audit roadmap, and this approach helps our clients prepare the required documentation for auditors to review so they can gain comfort in the overall calculations. So with that, I'll turn it over to Mike and Dan to walk through the roadmap.
Thanks, Raphael. When implementing the new lease standard, we definitely think that a company should favor a process that aligns with their current business needs. In addition, we think that the company should also remember that their auditors are going to audit their implementation process, its related assumptions, and its calculations. For our clients, we've planned our scope of work to match closely with this audit roadmap, knowing that they will need to provide their auditors with this type of information. In whatever approach you take for your implementation, we think that it's good for you to keep this roadmap in mind. At ProNexus, we've developed a three-phased approach to our implementation process that includes planning and scoping, assessment, and then execution. During the first two phases, we address many of the same questions, and we use a similar approach to the first four steps of the audit roadmap, where we 1, obtain an understanding, 2, assess risks, 3, develop a preliminary strategy, and 4, test the current controls. For example, we start with a lease assessment questionnaire that we review with each of the key stakeholders involved in a client's leasing process. This questionnaire provides us with such information as the client's current procedures, any controls that are in place, their current knowledge of the leasing standards, and their current compliance with ASC 840. Then, this questionnaire, coupled with other information we receive, helps us to gain a preliminary understanding of the overall leasing environment. From this, we will make an initial assessment of any current risks or deficiencies and prepare our work plan. We will also review the client's general ledger to test whether our understanding matches with their actual process. In a similar way, our execution phase also aligns with the later steps of this roadmap, and Dan will now review those steps.
Thanks, Mike. Yeah, steps 5 through 8, auditing the prospective period. That aligns with our phase 3 of our process. You will have to perform and document all the financial support for implementing 842 for substantive testing. This will include, but not be limited to, review of all contracts to determine if they qualify as an 842 operating or finance lease. Do we have all our leases? Document all the data points needed for the calculation of the ROU assets and liabilities, and determine rent expense types and test for completeness. Determine the discount rates to be used to calculate the present value of payment streams. What is our methodology for determining discount rates? How are these rates going to affect the present value of our lease payments? Develop the journal entry and support to recognize the ROU asset and liability to be booked on day 1. Develop and document the transaction process to record amortization and rent expense for day 2 and beyond. This will not only include the day 1 leases, but also the new leases, impairments, remeasurements, exercising options, amendments, the list goes on. To accomplish this, you will need to have an understanding of significant accounts and classes of transactions. The processes and controls that you employ to address the completeness of your population of leases, the completeness and accuracy of the lease data used in calculating the transition adjustments, the calculation of the transition adjustments, and the design and establishment of new accounting policies and procedures to address the accounting and disclosure requirements under 842 or IFRS 16 or GASB 87. Finally, completing the 842 audit of procedures, accuracy, and completeness of the new disclosures required.
Thanks, Dan. As a reminder to everyone, if you have any questions, please use that Q&A feature at the bottom. We'll try to address them as we go through. Okay, on this slide, there are 6 key roadmap steps to get started. First, you'll need to understand the new rules and what the risks are. Secondly, you'll need to perform an assessment and understand the implementation challenges and risks. Next, you'll need to staff the project team, which includes identifying a sponsor, a project manager, and assigning a cross-functional team as well. You also need to evaluate the maturity of your current lease program. For example, what systems, processes, and controls are in place. Then you'll need to define the project scope and strategy. For example, are you just looking to comply, or do you want to implement best in class? And lastly, you'll need to define the budget and the time frames. And after completing these 6 steps, you should be in a good position to get started with the implementation. The 5 keys to success for the lease accounting project. The first is to build a cross-functional project team. Other than accounting, you're going to want input from other teams such as legal, procurement, IT, real estate perhaps, and tax, just to mention a few. The second key is to pinpoint the issues with the technical accounting. Embedded leases and equipment leases, for example, are consistently reported to be more challenging. The third key is going to be collecting the data, which will be the hardest part, and we'll cover that piece in a later slide. Next is choosing your software package carefully. Again, we don't recommend using Excel. It's cumbersome and prone to errors. We can help you select and implement software that will meet your requirements. If you partner with a firm like ours, we have invested in lease accounting software, and the software, as mentioned before, is cost effective, and you can simply use it to comply with the new standard. We'll discuss software further on another slide. Lastly, you'll need to set up a model for day 2 compliance and beyond. So performing the accounting on an ongoing basis will require processes that keep the lease leasing data accurate, complete, and up to date. You'll need to establish policies and controls for lease management. And for day 2 compliance and beyond, you could also partner with a firm like ours and outsource the maintenance of the software and the recurring compliance if you so choose as well. Some of the common mistakes we've seen include ignoring non-real estate leases and internal controls and post-implementation. The data for non-real estate leases will be much harder to collect. Most companies do not have a centralized group nor an enterprise application to track them. Post-implementation success requires the development of a repeatable process to consistently maintain accurate and complete lease records to comply on day 2 and beyond. It also requires automating processes for tracking changes to leases. And lastly, you'll need to have some systems, processes, and controls in place that will stand up to an audit. Before we walk through the workflow plan, we want to cover what companies typically lease and where these leases can be found within an organization. So in addition to your real estate leases, here on this slide, you'll find some of your typical non-real estate leases, for example, your IT and data center equipment, vehicles, and manufacturing equipment, to name a few. And as mentioned previously, some of the non-real estate leases could be embedded in procurement contracts. This slide illustrates the 11 places to look for leases, which includes anywhere from accounts payable to the IT to legal. In some cases, our clients couldn't find some leases and we had to go to the lessors as well. Because there's so many departments involved, it's important to build a cross-functional team for this project. And before we begin with the workflow plan, we're going to give you 15 seconds to answer our second polling question. Excellent, thank you. Okay, on this slide, this represents a typical workflow plan that we use when implementing the new standard, and this aligns with what to expect from your audit firm as discussed previously. Now, the first is the assessment. One of your first tasks will be the assessment and obtaining an understanding of your current state lease processes and the relevant procedures, data, and systems involved. The assessment will allow you to determine the size and scope of the overall work effort. For lease accounting projects, the complexity will not necessarily correlate with the size of the client's company or their annual revenues. Instead, it's really going to be more of a function of the complexity of the lease portfolio and the maturity or immaturity of the related processes. We have a survey questionnaire that we use as a starting point. We also interview and speak with the lease stakeholders. And during this process, there might be some opportunities as well to identify some savings by not only solving your lease accounting problem, but by enabling better lease administration as well. The next task is to perform an enterprise-wide lease census. Our goal here really is to build a master lease of all leases, a master list, I should say, of all leases, including embedded leases. We just reviewed some of the assets companies typically lease and where to look for them. We have a checklist that we go through to ensure completeness. We document the testing performed, so this can be provided to your auditors. As we perform our review, there are several places to look and questions to ask to build that census. Some of the questions we ask to build the census occurs during the assessment phase. Key questions include, who negotiates the leases, who manages the leased assets, and who reports on those leases, just to name a few. Another task in the workflow plan is to define the project strategy. On one hand, your leasing program may be mature and you decide the strategy is just to comply. On the other hand, you might want to do more than just comply. There may be some significant savings opportunities and you decide that the strategy is to transform. As you're performing the work, the end goal is really to design the future state, which applies to day 2 and beyond compliance, which is number 4 here on the workflow plan. Here you want to design business processes and systems for the future. The fifth task is to determine how long the project's going to take, the resources required, and estimating the budget. Number 6 and 7 on this slide, collecting the lease accounting data coupled with the contract review, I would say is the most time-consuming aspect of the project, which is our phase 3. We have a list of 100 data elements that we recommend clients abstract from their leases. With some of our clients that are implementing a more robust program, we've seen as many as 180 data elements collected. So let's skip ahead to slide 24 for a minute. Starting from the lease census on this slide, this schedule really summarizes the different activities required to collect your lease accounting data. The information is split between 2 phases, the planning and analysis phase and the data aggregation and upload phase. Let's go back to the workflow plan to talk about the contract review process. So for number 7 here, in terms of labor effort, on average, it takes 2 to 4 hours per lease on the low end and 6 to 8 hours on the high end to review contracts. I'll also tell you that if you have people that don't have much experience reviewing contracts or understanding the legal language, it could take those folks up to twice the amount of time than experienced professionals. For example, Mike, who's a senior manager on our team, can review contracts on average 1.5 times faster than some of our seniors on the team. In terms of policy elections, we already covered that in pretty good detail, but I would add that in some cases, clients will ask us to prepare a Performa analysis to support some policy election decisions. For selecting a software vendor, let's go to slide 25 on that one. Okay, so as mentioned previously, we would highly recommend considering Lease software solutions. Our software is the only lease accounting software made by former CPA firm auditors. This software was named the best lease accounting software by digital.com and was rated #1 easiest and most accurate lease accounting software on the market out of 80 software solutions that are out there. Our experience using Excel to manage the ongoing compliance is difficult and will increase your risk. Trust us, we've tried it. For example, there is no segregation of duties, there's limited access controls, inadequate audit trails, change reporting and version control doesn't really exist, and it's a lot of tedious and manual contract remeasurements, modifications, and adjustments that you'd have to do in Excel. ProNexus has the lease accounting software on the cloud that we use to implement the new standard, and it complies with all 3 regulations, FASB, the IFRS, and GASB. And this slide illustrates some of the essential and innovative features the software offers. The software provides you unlimited users, and you're only charged based on number of leases, which is a nice feature. The software is cloud-based. It acts as a central repository for all your leases and supporting documentation. Your auditors have access to it as well, which is nice. It has a lease classification, lease term, and embedded lease wizard to guide your staff with proper accounting of leases, which is a great tool to have. The software is designed to comply with the new standard by providing you all the reporting required, including the amortization schedules, the journal entries, and automated footnote disclosures as well. Lastly, it has audit trail features, and as I mentioned before, you can give access to your auditors so they can get all the documentation they need with the leases. If you're required to comply with GASB 87, which is the government entity version of 842, we will be performing some GASB-specific software demos later this year. If you're interested in the software, we can send you an on-demand recording of our demo. And I think we have a software demo coming up on March 16th, if I'm not mistaken, as well. With that, I'm going to give you 15 seconds to answer our 3rd and final polling question. Excellent. Thank you, everyone. Okay, so we've made some recommendations throughout the presentation. However, this slide really summarizes them all in one location. Our first recommendation is to make good policy elections. Next, get an early start on understanding the impact on your banking relationships, and check with your banks once you understand what the impact is for your organization. Third, allow sufficient time to implement. Next, choose a software solution in place of spreadsheets. Next, partner with a firm to provide some advice, supplement your team, or even outsource. Lastly, take action as soon as feasible. It's important to assess the size and complexity of your lease portfolio, the strength and current centralization of your processes for leases, and the scope of your implementation process. As with any standard change, it's important to get an early handle on it and get the experts involved when needed to provide the best and most prudent advice. The new lease standard is subjective and open to interpretation, and having the supporting documentation for the policy elections and the confidence in the calculations will make for a smoother implementation for you. If you feel like you're behind, or you do want an independent, objective look to confirm you're on track, or even if you have some gaps you'd like to address, ProNexus can help you. We've been working on this for the last 2+ years. It started out with the publicly traded companies first, and then the privately held and not-for-profit started. We've invested in the software. We've developed a ton of IP and tools that you can just leverage and help you accelerate your implementation. If you look at this slide, we've got the assessments, we have the lease summary abstracts, we even have the project governance and project team templates with the definitions of the different types of folks that should be on the team. We even have the validation checklist for testing of completion. We also have all the lease data fields that are required, the best practices in terms of what to abstract from these contracts. We do have the decision trees available in terms of whether or not it contains a lease, although the software also has the wizards available to you. We do have contract review checklists. We have Microsoft Excel templates for a mass import into the software, and obviously we have the software as well. If you're looking to partner with a firm, we can help you in a variety of ways. We can help you understand the new rules. We can help you with the roadmap development. We can help you with the planning and scoping phase, the assessment phase. We can help you with software selection as well. We can even help you with the people, processes, and controls aspect of this initiative. We can also help with project support and execution. Some clients, some larger clients especially, had some of their own people on the project, and they asked us to backfill some of the day-to-day roles. And then there's outsourcing or co-sourcing for day 2 and beyond compliance, actually maintaining this program on a going forward basis. And we've also offered some training for clients as well. So how you structure the resources, tools, and expertise to implement the new standard can vary. We can sit down with you and discuss your requirements and the options available to each of your organizations. Wonderful. I think we've gotten toward the tail end of today's webinar. Thank you for submitting your questions. It looks like we have picked a few to respond to today. If we can't get to all the questions, please feel free to reach out to us at the end. Just a reminder, if you are interested in the software, we can send you an on-demand pre-recorded demo of our software. We do have a live one coming up, as I mentioned previously, on March 16th. And now we'll take the remaining time here today to answer some of your questions. So thanks again for joining us. We hope you found this information valuable. So Dan, do you want to take a look at the questions and see what we've got for us?
Yeah, so somebody's asking for reiteration on, like, based on the delay of implementing the lease accounting standard, what can we do now?
Okay, I can take that one, Dan. And in the meantime, there was another question that was asked if you want to take a look at that while I answer this question, okay? All right, so for those companies, to answer that question, for those companies that have started implementing, we recommend continuing the implementation efforts at a less rigorous pace. For those that have not adopted at a minimum, we recommend to get started now with one of two options or a combination thereof. The first option is really to complete that planning, scoping, and assessment phase that we alluded to earlier. This is not a lot of work. We usually can get that work done up to 100 hours, depending on the size and complexity of the client it takes our firm to do. But it will really provide you the visibility to what's ahead while identifying some of the high risks and planning to accordingly to meet the compliance deadlines. The second option is to purchase this lease accounting software. We've been doing this a lot with clients as well, where they've acquired the software. Some of them took advantage of that 2-for-1 promo that we ran earlier this year or late last year. And, we took the existing contracts and leases under 840 and started abstracting the data elements from those leases and uploading that information into the software. That allows you at least to start maintaining the existing lease data in a central repository, estimating what your day one ready-use calculations may look like, and allow for a quick and seamless implementation when the time comes. Dan, did you want to, Diana, Mike, do you want to address this question here? It sounds like we've got a question. Oh, did you answer it already?
Yeah, I answered a couple. I don't know if we want to talk about those a little bit more, but is cloud software considered a physical asset? And normally it is not, unless for some reason there is, for example, the transition of the software to the lessee at the end of the contract. So that's a good question. We always do an analysis and a documentation by reviewing a scope of your IT type contracts to either conclude that you may have some 842 leases, or most of the time when we find out that there's nothing real material and they will fall under a special pronouncement and qualification, and they do not create an ROU asset and liability. But of course, you need to go through and read those contracts and again, create the documentation to prove to the auditors that these are not 842 operating or finance leases. So if you had a software contract and a cloud software contract, and you owned that software at the end of the 3-year term, that may qualify as an 842 operating lease.
Yeah, Dan, this is Mike. I think there's this is a really good question because it comes up a lot, whether it's cloud-based or other virtual services like, some kind of, server hosting or things like that. Really, as Dan mentioned, you got to look at the contract. But what it comes down to, it really is control in this instance. And for the software, you typically don't have the right to the source code. You can't change things. You can't modify it in any way. You're just very limited in how you can use the asset. And the same thing happens with some of the server farms that are being used more and more these days, in that you have no control over what servers the hosting company is using, what software they're putting on them, changes that can be made. In most of those instances, they're not considered a leased asset because you don't have that control. But that's where, as Dan says, you have to look closely at the contract and see whether or not maybe there is something in there that gives you control over those assets, specifically how they're being used. Do you have a separate room set up, for instance, that has your servers set aside from other clients of that hosting company?
Yep.
Thanks, Mike.
Good point.
There was another question, I think, in here, Dan. What problem did the new lease standard address? What user of financial reporting was pushing for this change? And then it says, if the concern was understanding assets and liabilities for operating leases in the past, is this cure more costly than the benefits of more precise reporting?
Well, I kind of, I'll give an answer, then maybe Mike can throw a comment in there too. The problem trying to be solved by the new lease standard is that the large obligations that companies were creating through leases were never part of the balance sheet presentation, right? They didn't really affect it. We kind of look at it as that the old 840 was kind of what you would say like a level D type audit concern, where now it's a class A. And I think it was over $3 trillion for the public companies of added assets and liabilities through this new standard. So as you can see, when 840 came along, there was enough loopholes. Well, everybody stopped doing capital leases and wrote it so it'd be an operating lease, so they didn't have to record it on the balance sheet. And FASB kind of tried to correct that loophole. And of course, this was pushed by, investors, banks, etc. They wanted to see this on the balance sheet to get a clear picture of what the company's obligations were and for how long those obligations lasted. So, and then the third question is, that's up for debate. I've been to a couple other webinars and seminars where that's, some people believe that it's very good and other people are saying it's too costly for the benefits. But, at the end of the day, that's what FASB wants, so that's what FASB gets. I don't know if you got anything you could add to that, Mike?
Sure. I think, you were right, Dan. It's that off-balance sheet accounting was one of those main problems that was brought up. There were all the problems with Enron and, some of those other, companies that, were trying to hide liabilities. The attempt of the lease accounting standard is to make it more visible to the users of the financial statements as to what the actual obligations and liabilities of those companies are. As to whether or not it's more costly, as Dan mentioned, that's kind of up in the air. Although some companies that we've worked with have taken this as an example to really improve their internal controls, because in a lot of cases, companies were very lax in how they were approving and overseeing leased assets, and there was no clear definition as to who could approve those and how they were getting paid. And some of the companies that we've worked with have tried to really close that loop and say, okay, let's make this process a little bit better. We're going to specifically define who can approve these, and we're going to track these in a better manner. It takes a little bit more time and effort. Some of the softwares that are out there, will add additional cost, but overall they think that it improves those internal controls.
Thanks, Mike. Thanks, Dan. Final question here. Maybe Caitlin, this might be for you. Someone's asking if we provide the hard copy of the slides. I know we provided the recorded version of this webinar, but did the slides go out as well? Caitlin, are you
Yep,
still on?
I can send a PDF version of the slides out as well.
Okay, great. Well, I think that does it. Sorry we went over a few minutes, but I want to thank everyone again for joining us. We hope you found this information valuable. Feel free to reach out to us if you have any other further questions or you need some help. We'd love to connect with you on any issues or questions that you have. So thanks again, everyone, and thank you, the panel, for your time today.
Thank you.
Bye now.